Welcome back to The Deep Dive, where we take the sources you share and turn them into a clear, insightful knowledge path designed just for you. Today, we are strapping ourselves into, well, what might be the most volatile, exhilarating sector of the market, the new space economy. Our focus is on Sidus Space Inc., that's ticker SIDU, a company that just perfectly embodies this whole idea of high risk, high reward.
Oh, absolutely. It's a textbook case.
We have a detailed investor's guide here, and it shows a real dichotomy. On one hand, you have a tech pioneer landing these huge, high-profile contracts, but on the other, it's wrestling with a pretty stark financial reality.
That's putting it mildly.
So our mission today is to pull out the crucial insights from that duality. We need to understand their tech edge, really scrutinize those massive potential contracts, and then most critically do a cold, hard financial health check. We need to know what you're really buying into. Okay, let's unpack this.
So Sidus Space is really trying to position itself as a space-as-a-service pioneer.
You hear that phrase a lot. What does it actually mean for them?
Well, for SIDU, it means they're aiming to be a comprehensive, an end-to-end solution provider.
Right, so it's not just, here's a satellite, good luck.
Exactly.
Yeah.
Not at all. They manage the entire life cycle for a client. That includes everything from, say, designing and manufacturing the satellite, arranging the launch, and then this is the crucial part, managing the space-based data analytics that clients are actually paying for.
The insights.
The insights, whether that's Earth observation, weather data, or, highly specific reconnaissance. They want to own the whole process.
And the centerpiece of that whole service model is their proprietary small satellite, the LizzieSat. This is where the tech story gets really interesting because the source points to a huge enabler: 3D printing. Why is that such a big deal for building something that goes into orbit?
It completely changes the equation on time, cost, and flexibility.
How so?
Well, traditional satellites are built using these decades-old supply chains. They're rigid with fixed components.
The long lead times.
Very long lead times. But LizzieSat, because it's built with 3D printing, allows for rapid prototyping and, most importantly, just extreme customization. If a client, let's say the Department of Defense, needs a unique sensor package integrated tomorrow, Sidus can, in theory, design and print those components incredibly quickly.
So you're going from years to months.
Or even less. That speed is what lets them deliver the service part of their pitch.
And that flexibility is clearly opening doors because their client list is, well, it's undeniable. We're talking NASA and the U.S. Department of Defense.
And those names are the ultimate stamp of technical reliability, aren't they?
Absolutely.
Working with NASA means you meet these incredibly rigorous engineering standards. And working with the DoD means you can handle high security data and mission-critical operations.
It's a huge barrier to entry.
A very high barrier. For an investor, that client list says a lot.
Okay, that sets the stage perfectly for the massive potential. So you have an innovative company with premium, sticky clients. Let's talk about the upside that has caught the market's attention because it led to some extreme price movement. Here's where it gets really interesting. We saw an incredible, a shocking spike in their stock recently. The sources show it surged over 160% in a single day. That was January 2nd, 2028.
Right.
A move like that suggests the market thinks some kind of paradigm shift is happening, and it seems to be tied directly to these big defense contracts.
Yeah, and that speculation is, look, it's entirely rational. It's being driven by the news of their selection for the Missile Defense Agency's SHIELD contract.
And this isn't just winning a small bid.
No, this is entering a multi-billion-dollar ecosystem.
That's the detail we have to dwell on for a second. The potential contract ceiling is listed as up to $15.1 billion.
And you're right to stress the word potential.
Yes, because it's the absolute maximum the Pentagon could spend. It's not a guarantee.
It's not. It's an opportunity to compete for a massive slice of that spending. But just being selected for a vehicle that large, it completely changes the perceived scale of the company overnight.
Even if they only get a fraction of it.
Exactly. Even a fraction is transformative for a company this size.
And this opportunity isn't happening in a vacuum, politically.
Absolutely not. If we connect this to the bigger picture, we are seeing significant, let's call them geopolitical tailwinds, rising global tensions, increased defense budgets, especially for the U.S. Space Force. All of this is driving demand for what Sidus provides: satellite reconnaissance, resilient data services.
So the need for their service isn't speculative.
No, it's a current strategic necessity. They are positioned perfectly to capitalize on this.
So beyond the contracts, what's the internal growth roadmap look like?
It's really focused on three key areas. First, just scaling the LizzieSat Constellation itself, You need more than 1 or 2 satellites for global coverage.
Of course.
Second, they're investing heavily in on-orbit AI, which is, what we call edge computing here.
Okay, operationalize that for us.
Yeah.
Edge computing. What does processing data in space actually mean for a client?
It means speed. Right now, most satellites collect a ton of data, say images, and then have to beam all of it down to a ground station to be processed. It takes time.
A huge bottleneck.
A huge bottleneck. Edge computing lets the AI analyze the data on the satellite and only send down the actionable insights. It cuts the time from observation to intelligence from hours to minutes.
Wow, for military or disaster response, that's everything.
It's a massive differentiator. And the third piece is just advancing their 3D hybrid manufacturing to make it all even faster and cheaper.
So we've got a really clear, exciting, high-reward story here. Cutting-edge tech, huge defense contract potential. Now, we have to pivot sharply to the other side of that coin, the high-risk component. And that starts with a cold, hard look at the financials, which are, frankly, startling.
They are, and it's why this is a true high-stakes investment. You just look at the contracts and the core financials over the last 12 months. Revenue is just $3.62 million.
Okay, $3.6 million. But the cost to build all this, that hits the net income line. And that number is negative $23.75 million.
Correct, and that massive negative net income is the definition of a pre-revenue infrastructure building space company.
So for every dollar they earned.
For every dollar they earned, they spent more than $6 just to stay operational, invest in R&D, and launch those initial LizzieSats.
And launches aren't cheap.
They are prohibitively expensive. They're just consuming capital at an alarming rate to build out that constellation.
Let's dig into the performance metrics that really show this. The guide points out their return on equity, or ROE. It's listed at negative 142.8%.
That number should immediately set off alarm bells for any listener.
Explain why.
Well, ROE tells you how effectively a company is using shareholder money to generate profit. Positive means you're growing the capital. Negative means you are burning it. And negative 142.8% isn't just losing money. It represents a severe and rapid erosion of shareholder capital.
Put that in context for us.
A company with, say, a negative 40% ROE is usually considered to be in distress. This figure means they're burning through capital at an unsustainable velocity just to fund operations.
Which brings us directly to the huge red flag here, the high cash burn rate. The company's relying heavily on new stock offerings to fund everything.
That's right. They're using the public markets as their ATM, basically. Issuing new shares just to keep the lights on and the launch schedule moving.
And the consequence of that is share dilution.
Immediate and significant share dilution for existing investors. When you flood the market with new shares, it waters down the value of every single share that's already out there.
It's the painful price of funding this kind of capital-intensive tech.
It is. They need the cash, and the fastest way to get it is by diluting everyone else's ownership stake.
That constant need for cash and the need to fight giants brings us to the specific investment risks. The first one is just intense competition. Sidus, for all its innovation, is in a market dominated by, aerospace and defense giants. Lockheed Martin, Raytheon.
It's a David versus Goliath scenario, except there are several Goliaths.
Right. And David has a very innovative slingshot,
But David's weakness is longevity and cash flow. The giants can weather a bad quarter. Sidus really can't.
And that fragility leads right to the second risk, extreme financial instability. Their future is completely dependent on securing continuous funding.
Through either more of those punishing stock offerings or, ideally, consistent revenue, they have to achieve profitability before that cash burn rate forces an unfortunate end.
And this brings us back to the SHIELD contract, right? Because securing a spot on it also raises a risk, uncertainty of revenue.
Exactly.
I want to clarify that again. How is a $15.1 billion contract opportunity uncertain?
Because being pre-qualified to bid on work is not the same as winning a long-term stable contract. Government funding is cyclical. It's project-based, it's politically dependent. A small company like Sidus could win a huge, say, $500 million project one year.
And then nothing the next.
And then face a year of very little revenue while the next phase gets approved. That irregular funding stream makes financial planning, it makes it extremely difficult when you have massive fixed costs.
And on top of all that, there's that external risk we saw with the 160% surge, meme stock volatility.
This is a huge factor. High retail ownership makes the stock susceptible to these wild price swings driven by pure speculation, by social media noise.
So it's not trading on the fundamentals we just talked about.
No, not on the $3.6 million in revenue. It's trading on the hype and the potential of the future. And that adds enormous instability. So if we connect this to the bigger picture, the reason the guide labels it high risk becomes crystal clear. Sidus has to fight against entrenched, deep-pocketed competitors and satisfy the demands of speculative retail investors, all while maintaining a massive burn rate to build the infrastructure they promised to their government clients.
A high-wire act.
It's a high-wire act with no safety net.
Okay, that brings us to the synthesis of this whole deep dive. We've looked at this extreme duality. On one side, a pioneer with cutting-edge tech, a flexible product, high-value clients like the DoD and NASA. But on the other side, severe financial instability, massive losses, and this wild stock volatility. So what does this all mean?
Well, the fundamental challenge for you, the listener, is to understand that the company's entire value proposition hinges on one single factor. It's their ability to rapidly convert the potential of that $15.1 billion defense contract into a sustained, continuous, and predictable revenue flow.
And they have to do it fast.
They have to do it quickly before the current cash burn rate forces even more punishing share dilution. They are in a race against time and their own balance sheet.
It's the ultimate race against the clock. They've built a world-class engine, they've secured a spot on the most valuable track, but they're paying for it all on a credit card that is about to be maxed out.
That's a great way to put it. They're betting the revenue starts flowing before they run out of ways to raise capital.
Which leaves us with a final provocative thought for you to consider as you finish your own research. Given that Sidus Space's survival is so dependent on these large, irregular government contracts, does that relationship make the company inherently more secure because of the high barrier to entry? Or does it actually make them more volatile because of the unpredictable nature of public sector funding?
The difference between becoming an industry pioneer and just a forgotten footnote often lies right in bridging that exact financial gap.
Thank you for joining us for the deep dive. We hope this has given you the knowledge shortcut you need to understand the complex, high-stakes world of Sidus Space. We'll see you next time.